Thanks, Stan, for having us here. Now, this year, we expect prices to be largely influenced by the demand growth in the emerging economies, particularly, the impact of reopening of China. So, if you look at for quarter one, the prices remain supported around 84, 85 dollar per barrel. One, because of the reopening of China, and demand growth stabilizes. The second is the fear of a large loss of supply from Russia also has minimized now, so that has stopped supporting the prices to the levels we have seen last year. And third, we see higher crude demand from the refining sector to support the diesel market after the EU ban on Russian products came in place. So yes, at the end, we shouldn't also forget that the demand growth is also dependent upon the global economic recovery, which still remains fragile. We're expecting a weaker GDP growth for this year compared to last year, particularly in the OECD economies. So we expect larger downside risk from the OECD economies, particularly from the high inflation, high interest rates. And not to forget, any escalation, in the geopolitics around Russia-Ukraine crisis could also derail the global economy.
How much of a wild card is Russian supply in particular right now?
Well, if you look at Russia's crude exports, after the ban on Russian crude import from EU, there was a knee-jerk reaction in December where it went down, but we have seen the exports re-emerging back and rebounding again to more than 3 million barrels per day. I'm talking about the waterborne exports from Russia. So I think from that perspective, we have seen new buyers emerging in China and India. They will have to keep on buying more and more of Russian crude. And the discounts which Russian crude is offering at around more than $40 per barrel versus Brent is facilitating that movement. Now, the next impact which we could see will emerge from the product ban and the product price cap, which came in effect on 5th of February this year. Now, what that means is Russia will also have to find...
Let me just jump in here for a second as well, because as all of this plays out, of course, geopolitics is front and center, particularly when it comes to Russian supply. What about the United States? Is the administration getting it right when it comes to the SPR buybacks?
Well, at some point, the SPR stocks in US are, historically low. So, at some point they will have to fill up those reserves, and that could provide some support to the overall crude demand in the market. But at what price level? That's the key thing. Price $84, $85 barrel, and we think the prices will appreciate as we move into the year. So whether that's the right price level to buy, I think that's a big question.